Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending February 24th. Had a pretty bearish week in the markets across most sectors and all the major indices, including the cryptocurrency space, with pretty much broad-based selling on the week. So let's dive into the charts and take a look at what we're seeing here. Starting out with the Bitcoin chart, sitting at just below 23,000 on Bitcoin. We had a couple of attempts to get above that anchored VWAP level at about 25K, and that ultimately failed, and we started to see price break down this last week. So now we're watching to see if we can find support at this 22.5 level, which has been an area of resistance in the past. And so we'll see if we can ultimately hold that. We're also pretty fast approaching the 50-day moving average, which is currently sitting at about 22.2 or so. And so we'll see if either that 50-day moving average or that trendline support at about 22.5 can ultimately hold. And if we'll see Bitcoin continue to head higher after a bit of a correction, or if this is ultimately a breakdown in cryptocurrency. So we'll have to keep a close eye on these charts and see how it plays out over the next week or two. Still, my best bet on this is that it will most likely continue to go higher and ultimately get through that 25K anchored VWAP level, but we obviously need to contend with that first before we ultimately head higher. So we'll see how that shakes out in the coming weeks. And then jumping over to the Ethereum chart, we are actually just at the 50-day moving average on Ethereum, so a little bit lower on Ethereum than Bitcoin relative to the moving averages. And we'll see if that ultimately is going to be an area where we find support in Ethereum. We also have a pretty strong area of support at about 1550 or so, which is just below the 50-day moving average. So we'll see if those levels can ultimately hold. If we do see a breakdown below those levels, then we do have some Fibonacci retracement levels at about 1480, and then we also have the 200-day moving average of about 1442. So those would be the next areas to the downside I'll be looking at for support if ultimately these levels that we're at right now don't hold. And then take a look at the total cryptocurrency market class. We're just sitting above 1 trillion for the total cryptocurrency asset class at the moment. So we'll see if that is an area where we can find support and ultimately head higher from there. That's also right just above our 50-day moving average for the total cryptocurrency market class as well. Jumping over to the S&P 500. S&P 500 broke down this week as well in a bit of a corrective phase. We ultimately lost the 50-day moving average on the S&P 500, but we did find support, at least on Friday so far, at the 150-day moving average, which is just above the 200-day moving average. We also have this major trend line that we've been in for all of 2022, where we're kind of stuck below these levels, and so this is a pretty key area to watch for. I think if we're looking for some big moves further out of the S&P 500, we'd likely like to find support here pretty quickly on the S&P 500. I think we could potentially break down to about 386 to 390, kind of at the extreme side of things, to the downside, and potentially find support before we move higher. But if we ultimately lose that 386, which is an anchored VWAP level, then I'd be getting pretty bearish for the markets broadly. But as long as we're holding up above that 386 to 390 level, then I think we'll be okay and potentially continue to head higher from here. And so hopefully this corrective phase is close to over in the markets. Taking a look at the breadth on our S&P 500, we're at about 59% of stocks above their 200-day moving average and about 45% above their 50-day moving average. And so we can see on that 50-day moving average percentage, this has tended to be an area where we've kind of found support on the breadth measure, right around that 40-45%. And so we'll want to look to see if that ultimately holds. If we do see a breakdown, I'd say below about 40% on the 50%, or the 50-day moving average rather, then I think that would be a area of concern and likely suggest maybe we might see some further selling pressure in the markets. But if we see that breadth hold around these levels and then ultimately rebound, then I think we'll be getting close to the end of this correction and ultimately heading higher. On the 200-day moving or the 200-day percentages, we want to see that hold up above 50. If we do see further breakdown, if we see a complete breakdown below that 50% on the 200-day moving average, then I think that would also be a pretty bearish sign for the markets. But so far we're holding up above those key levels. Jumping over the NASDAQ, we corrected down to the 200-day moving average on the triple Qs, found support on Friday, so we'll see if ultimately that can be our final bottom on this correction and ultimately head higher. We do have an Elliott wave count that would suggest that we're pretty close to the bottom of our wave 4 correction, and then would likely see another leg higher here and so that's what we're looking for. But if we do see triple Qs break down below 288 or so, then that would be concerning, and if we saw it break down below 282, then I'd be very concerned about the NASDAQ pretty broadly, as that's a pretty key area of both volume support and an anchored VWAP positions, and that would also be the 0.786 retracement level. So any major breakdowns below 282 would be a huge cause for concern in the NASDAQ, but so far we're holding up above those levels, and hopefully we can hold that 60% retracement level, which we're just above right now. So we'll see how that plays out going into next week. When we look at the breadth measures on the triple Qs, we're sitting about 58% above their 200-day moving average and about 51% above their 50-day moving average. And so we'll see if that ultimately holds up. I'll be looking for another 50% level on that 200-day moving average to ultimately see that hold. And then on the 50-day moving average, we'd want to see it hold at least that 40% level for our triple Qs. And jumping over the Dow Jones Industrial Averages, we are still sitting in a bit of this bull pennant. However, we've kind of had to adjust these trend lines a bit, and that's kind of the challenge with these angled trend lines, is you can kind of see a nice little support area, and then ultimately it breaks down from there. But we still do have a decent little area of support here. We've got 3 touches at least on this bottom trend line channel, and we still have this upper trend line that's holding resistance so far as well. We do have our 200-day moving average about 323 on the DIA, so that would really be kind of the bottom end of the breakdown. If we did break down further next week, I want to see that 200-day ultimately hold as support to be bullish for the Dow, and hopefully this level will even hold, and potentially we might start to see some rebounds going into next week. Typically February can be a bit of a bearish time from a seasonality perspective in the markets, and we are obviously getting to the back end of February now. We've also seen a strong dollar this month, which has not helped a cause for stocks. We're not seeing a massive spike in the VIX or anything, so I still think there's a pretty decent chance that this correction is pretty close to over, and we'll likely continue to see the markets head higher. But if we lose some of these key levels we discussed, then we'd have to potentially reevaluate and see if the markets are ultimately breaking down from here. Taking a look at Dow Jones Transports, we broke down in the transports this week as well, but we did see a pretty nice hammer candlestick on Friday just above that 50-day moving average, and that was also looks like a key area of support around a Fibonacci extension level at that 14,360. So as long as we're holding those levels, then I think we can be cautiously optimistic on the transports as well. Then take a look at our Russell 3000 chart. This is a pretty key chart here that I'll be watching closely going into next week. We came back down after this breakout, after we've been in this kind of trending downward channel line for all of 2022. We ultimately broke up above that on our weekly candlesticks here back in on January 23rd, and so we've had quite a few weeks now above the breakout, but now we came down and retested that. We did blow through the 50-week moving average this week, so that didn't hold as support, and so we also have our 21-week exponential moving average coming up and touching that trend line support as well. So I think we're at a pretty key area on the Russell 3000 to watch. If we ultimately see that break down, get back down into this below this trend line and also below the 21-week EMA, then I think that'd be a cause for concern for the broader markets. But so far we're holding up above those levels. And then when we take a look at our New York Stock Exchange new highs and new lows list, we can see that we still have a little bit of declining new highs in the market, which is not really what we'd like to see, but it's not completely breaking down. And we are starting to see a slight increase in new lows. But when we look at the 10-day moving average on this, we can still see that we're above that moving average, and so as long as we're staying above that moving average, that's also constructively bullish unless we see that breakdown and these new lows continue to break out. But so far it's fairly minor at this point. Then jumping over to our Russell 1000 chart, our large caps also coming down to retest this descending wedge. So another key area to watch for this in the coming weeks here, to see if we can ultimately hold support off of those levels and then bounce higher. If we do see a breakdown below these levels again, then I think that'd be a cost concern for our large caps. We also have this anchored VWAP off the COVID lows at about 214, which would be another key area to ultimately see that hold as support. And then taking a look at our small caps, we actually saw small caps bounce a bit on Friday. It came up off of this anchored VWAP level at about 186 on the IWM. And so as long as we hold that as support, then I think that would be pretty bullish for the small caps and could be suggesting that the markets are pretty close to done correcting. But if we see this IWM break down below these levels and drop below our 200 or 50-day moving average, which is about 185 or so, 184 on the IWM, then that would be a cause for concern on our small caps. And then take a look at our bond market. So on the top panel here, we've got our TLT, the 20-year. We've had some sell-off in the bond markets recently too, as we had that hot jobs report come in and some other kind of macroeconomic indicators that kind of, I think, spooked the markets as far as rates are concerned. The Fed's been saying they're going to continue to raise rates, and now I think the market's starting to believe that a little bit more. However, I don't think we're going to still see any major rate hikes. I think they'll probably keep it still at that 25 basis points, and we still probably only get maybe 2 or 3 more rate hikes, I think, before we ultimately see that bottom. And now that we're seeing the bond markets are actually delivering a pretty nice return on yield, I think that's also ultimately going to drive more money into the bond market. And so I still think the bond market's going to be a great place to both invest and trade in 2023. But we do have seen this bit of a corrective phase over the last couple of weeks, and we've got this trend line here as acting as support. We've now touched that 4 different times, and so we want to see if that ultimately holds. If we do see a breakdown below that level, we also have a pretty strong area of support at around 99.50 or so on the TLT. If we see the price action break down below those levels, then I think we have to be a little more concerned about TLT in the short term. But so far things are looking okay here. And then we did see a bit of a breakdown in the IEF, the 7 to 10 year bond. We would have liked to see that 95.60 level hold, but we haven't really broken down too much further past that. So as long as we can see that get back up above 95.60, I think that would be a pretty bullish sign for the bond market as well. But if we do continue to see this fall apart in the 7 to 10 year, then I think we've got to be a bit more bearish for bonds, at least in the short term. And then jumping over to our growth versus value, growth is still outperforming value, but we can see that over the last, these are weekly candlesticks here, so over about the last 3 weeks, we've kind of started to kind of flatten out a bit at least, so we're really growth and value. Neither one isn't necessarily trending right now. And so if we do see the market start to head higher, we'll likely see growth start to outperform value once again. But if we ultimately see this chart break down and get down below this trend line here, then I think we need to be a little bit more concerned about a potential breakdown in the markets also. And then jumping over to our sectors that we track for the last 5 trading days for the last week, we can see pretty much everything was red on the week. The only sector that was positive on the week was natural gas. And we talked about for multiple weeks now how natural gas was just really beaten up. We'll dive into the UNG chart at the end of this video just to show you what I'm thinking about with natural gas going forward. I've definitely been doing some short and some long plays on this, and now I'm starting to look at it from the long side once again. So we'll dive into that chart a little bit, but other than UNG, the entire sectors, all the sectors we track really were in the red on the week. The only other sector that was flat was consumer staples, but we did also see some relative strength out of the agricultural space. Bonds were only down 0.5%, and then we also saw some relative strength in aerospace. We're only down about 0.7%, where most of the market was down pretty significantly. As we scroll down here towards the bottom, we can see a lot of sectors down anywhere from about 3 to 9%. So it was a pretty red week across the board. Not a great time to be long for this last week for sure. But again, hopefully this is just a bit of a corrective phase before we ultimately rebound and head higher. And then taking a look at our global markets, the VEU, so this is our global markets minus the United States. We are above our 50-week moving average, but we are getting really close to that, so we want to watch that level and see if we can hold that as support at about 51.50 or so in the VEU. If we can, that would be pretty bullish for the global markets if we can see a bounce off those levels. If not, then we'd be looking at some areas of support potentially around that 21-week exponential moving average. And if we see that breakdown, then we'd be looking for that 47.50 level for the next area to the downside on the global markets. Jumping over to the U.S. oil barrel prices, we're sitting at about 76.50 or so a barrel. Still a lot of sideways price action on oil. Not any real clear direction at this point, so we're kind of waiting to watch to see if this is ultimately just a bit of a bear flag before it then ultimately sells off a little bit further. If it does, we're still looking at that 200-week moving average as the likely area of support, which would be around 65.66 per barrel. Or if we do ultimately see a break to the upside, we're looking for a clear break above that 21-week SMA, which has been kind of the area where every time we've had a bit of a rally, we've hit those levels and then we've ultimately sold off from there. So a break above that 21-week EMA, or the SMA rather, would be, I think, a pretty bullish sign for oil and energy prices. But right now we're still kind of chopping around sideways there. Similar story in the commodities space. CRB index has also just been chopping around sideways for quite some time. Really haven't had any significant movement going all the way back to about September of last year. We've just kind of been stalling out, kind of chopping around sideways. I think there's a pretty good chance we do see that break down to the downside, but we really need to see price action close below that 264 level before we get too bearish on the CRB index. And then jumping over to precious metals, gold had a pretty nice run to start the year, but it's been in a pretty deep correction as of early February, so really for all the month of February. We started to see gold and silver sell off. Not super surprising, since we ultimately saw rates start to head higher, and we started to see some strength in the dollar as well. So we're looking for some support here on the GLD. We did go through our 0.618 retracement level, and so we need to ultimately see if that 0.786 retracement level can hold, and that's also sitting at our 200-day moving average as well as our 21-day exponential moving average. So we've got a pretty strong area of support around this 165, 166 level on the GLD. So I'd be looking for that as our ultimate area of support before we ultimately head higher on gold, and we're going to need to see that ultimately hold though. And if we see breakdown further beyond that level, then I think that'd be concerning for precious metal space. But I think there's a pretty strong chance we're getting close to the bottom of this correction, and then we'll likely be heading higher in the precious metal space. Silver also breaking down. We are still above our 0.618 retracement level though, so that's going to be a key area that we're watching for going into next week, right around 1893 on the SLB. We'll see if that can hold as support. If we do see a breakdown below those levels, we do have a bit of a gap fill to the downside potentially here, and so if we did lose those levels, then we could potentially be looking for a breakdown all the way down to around 18 or so on the SLB to essentially fill that gap. And so we'll keep a close eye on that. But if we do break down below that 0.618 retracement level, we'd be looking for that support right around 18 or so on the SLB. And take a look at our interest rates. 2-year rates started to break out, also above this slightly downward trending channel line here. Starting to move to the upside. Looks like it's going to try to get back up to 5% on the 2-year, and then we'll see if that ultimately is the area of resistance before it rolls over, or if it continues to head higher from there. And then jumping over to the 10-year, the 10-year has been trying to break out as well, getting above that 4% level, but it hasn't been able to so far. We've ultimately seen almost about a week or so where we've contended with this 4% level in the 10-year, and we can't get above it so far. So hopefully that'll be the case, and that 4% connect is some pretty strong resistance, and we'll hopefully see these rates roll over from here. But if we do see that breakout above 4%, then I think we've got to expect at least a retest back up to this 4.25, 4.3% level on our 10-year rate. And then take a look at our 30-year, also below 4%, hasn't been able to get above that quite yet. We've retested it a couple of times, and it's ultimately sold off so far. So we'll see over the next week or two whether or not this 4% is going to be the resistance area, and if we'll roll over from here, or if we do see a breakout above that 4% level on the 30. And the dollar we talked about being pretty strong for February, and we've seen a big move to the upside. We bottomed out right around 150 on the Dixie. Now we were sitting at about 105.25. I think there's at least a little bit more move to the upside on this. I'd be looking for a retest of the 200-day SMA, which is about 106.50 or so currently. So that's kind of the first area to the upside I'll be looking at for some potential resistance. If we do blow through that 200-day SMA, then I think we'd potentially be looking for a retest right around this 107.70 level, or this upper trend line as our next area of potential resistance. But I do think there's a good chance that the dollar is going to roll over here sometime in the next week or two, and that we'll likely start to see some dollar weakness going into March. Taking a look at the high yield corporate bond ETF, we came down off that after we had that breakout. We talked about how we saw that breakout off this HYG as kind of a market health kind of indicator chart we watch. Seeing that breakout was a pretty bullish sign, I think, for the markets, and we started going pretty long in the stock market after that happened, but then we've seen that roll over. We got up to that 50-week SMA, and that ultimately acted as resistance, and then we rolled over from here. So we've since broken down, but we did come down and retest this trendline channel, which we'd been in below that for all of 2022. So for a more bullish outlook on the markets, we really want to see that HYG hold that as support and then ultimately head higher from here if we're looking for the markets to ultimately head higher in the short term. So far so good on that, but we're watching that closely. If we start to see HYG break down below about 72.50 or so and get back down below this trend line, then I think that would be a cause for concern for the markets. And then when we're taking a look at our investment grade corporate bonds divided by our 7 to 10 year bonds, this is another chart we look at for kind of market health. Typically when we're sitting above the 21 week EMA, that's generally pretty bullish, and that's that white line here, and we were just sitting above that. We did break down just briefly on the week, but we ultimately rallied off of that and closed a bit higher, so that looks fairly good in the short term, especially if we can hold those levels. But as long as we're ultimately holding this purple line, which is the 21 week SMA, then I think that's still a reason to still stay constructively bullish on the markets. If I see that price action ultimately break down below that 21 week SMA, then I think I'd be a lot more concerned for the markets in the short term, but so far we're holding above those levels. And when we take a look at our put call equity ratio for the week, we did see a spike getting up above one level, which is elevated put buying protection. So we are starting to see some more caution in the markets as we spent multiple weeks where we really didn't see any close above that one level. We really saw about a month now where we've seen some pretty minimal put buying protection in the markets, and that obviously was supported with some pretty strong bullish price action in the market. So if we can see that put call equity ratio drop back down below 1 going into next week, then that'd be a good sign for the bulls, I think. So we'll keep a close eye on that. And then take a look at our VIX. The VIX ultimately, while it has spiked up a bit and is back up above 20, we're still staying pretty consistently below that 25 level. We actually haven't even broke above 24 quite yet on the VIX. And each time we've kind of had a big spike, it's tended to roll over pretty quickly. We can see even on Friday we had a bit of a spike up on that day, and it gave back most of those points on the VIX really intraday on the week. So still looking like the VIX is not having any massive spike to the upside. If we see a big spike up above 25, I think that'd be a reason to get a little more cautious in the markets. But as long as we're staying below that 25 level, and especially if we see it break down below 20 again, I think that'll be a good sign that the markets are likely just in a corrective phase and will ultimately be heading higher. Go ahead and close out the week with this UNG chart. Natural gas has been talked about quite a bit on financial Twitter, and a lot of the YouTubers and whatnot talking about just the massive oversold nature of natural gas. So we had a really warm winter, and that's really put a lot of bearish price action on the natural gas space. And but we've just been extremely oversold on this thing. This dashed blue line is actually our 10-year logarithmic averages, and we've got this 2 standard deviation on this blue line here. We just about got to those levels to the downside, and so that's historically a pretty extreme oversold reading when you get to those to that 2 standard deviations, to whether it's the downside or the upside. And when we get to that level on the downside, then it's a pretty safe bet, at least in the longer term, that we're likely going to ultimately head higher. If we just get a mean reversion on our log chart here, that would mean we'd get price action back up to about 1175 or so on the UNG, which would represent about 45% of upside from here. And if you're trading the leverage ETF oil, that's giving you a 3x. So if we do get just a basic mean reversion up to that 1175 level, that represents almost 150% worth of upside. So that's definitely a trade that I want to be in if that happens, and I think there's a pretty strong chance it will happen at some point. But we still do have to kind of contend with this bearish price action that's still sort of going on, but we're starting to see some positive indicators here. We start to see UNG break out above 9. If you want to be a little bit more cautious on the trade, a clear breakout above 9 I think would be a much more bullish signal. But I actually traded it off of this lower level at this previous UNG lows, which was just above $8 per share. And so I'm using that kind of as my stop loss area. As long as price action doesn't close below that $8 level, then I'm staying long on this one with the boil and looking for that big upside, at least just to the mean reversion level at that 1175 on UNG, which would represent a really nice trade to the upside and pretty minimal risk off of these levels as well. So thanks for tuning in. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. And you can check us out at ToroAlerts.com.